But we also got a lot from Sebi's board meeting on Wednesday. So let's talk just a little bit about that. The regulator has made it mandatory for listed companies to clarify on all market rumors, which is great for stakeholders, shareholders, etc. The top 100 companies must verify, deny, confirm or clarify on rumors from October of this year. Sebi has also emphasized the responsibility of asset management companies to protect investor interests. Sandeep Parekh, managing partner at Finsec Law Advisors, and Hetal Dalal, president and COO at IiAS, joins us now to talk about that. Gentlemen, morning to both of you. Lady and gentlemen, morning to both of you. Sandeep, I want to start with you first. Of course, all of this is done in the interest of the investor and the shareholder. But tell us a little bit about what the key takeaways were for you, both from a company perspective as well as from an investor standpoint.
Hi, thanks for having me here. So I'll be quick on the two kind of specific questions that you asked, because the board meeting was, of course, as you know, it discussed a lot of things, more than a dozen things, really. So, first of all, I think, the broad investor interest has been kept in mind for sure. I think the only question is, does it become very costly to really kind of comply with the norms? And, I'll give you the answer to your first question in terms of every time there's a rumor now, so they've limited to mainstream media. So it will probably be Economic Times, CNBC and the likes, and not every time somebody posts on Twitter. Every time there's a rumor which is inaccurate or kind of sometimes mischievous, a company would be obliged to kind of come out with clarification. So I think it would certainly impose a cost on companies which have to now track a lot of events happening in the media rather than in the real world. And as you know, many times there are just rumors, and if they to quash every single rumor which crops up, it could impose some kind of some distraction from real work. But I think it's a manageable cost. So that's okay.
True.
In terms of mutual funds,
I just wanted to get Hetal into this conversation as well, just on the point that you made, because Hetal, that seems to be the problem, right? It's fine, it looks okay on paper, but it seems to be a bit impractical. There is perhaps a cost involved. How easy will be the implementation of this? You can't be quashing every single rumor that comes out, especially in this digital age. How do you track it? Your thoughts?
I think this is a tricky one, and it's been hotly debated when the consultation paper also came out. I think by and large the intent is correct in terms of saying that there are rumors and therefore there needs to be more clarity in the market, and to ensure that there is no price run or drop just because of rumors. The challenges are, if you look at it, there are three players in this entire argument. One is the stakeholders, the other is the company, and the third is the media. Now, let's take a simple argument of a company simply saying that someone puts out, and there are several examples of this, that a media report sort of comes out saying the company is going to acquire another company, or there is a transaction which has happened. Now, the transaction is stages of negotiation. The company actually cannot confirm nor deny. So this becomes a bit of a tricky spot in terms of saying that what does the company therefore do and how does it address this particular rumor. I think the other piece, when you look at media, right? It's very easy now for media to be mischievous if it wants to be. So let's say the transaction is happening at 1,200 rupees for the sake of argument. Media is a rumor. Media puts out a number. Now the company has to confirm or deny whether the price is going to be 1,200. So it can be easily manipulated. I think we need to see how this, and for investors, of course, there's great clarity because now you know whether it's actually happening or not happening, whether it's going to be higher or lower. But I think the implementation is likely to be tricky. I think the intent is right. We'll have to see how this plays out over a period of time and then sort of address, the nuances. But by and large, what it also therefore tries to sort of force is better stringency around how this data is getting leaked. So all parties to a transaction, for example, will have to therefore be extremely careful about information and security. And I think these are things which will drive greater and stronger processes within the system. But like I said, there are pitfalls, and I think we'll have to see how it plays out. But by and large, the intent is right.
There is a mechanism. Morning, Hetal. Morning, Sandeep. There is a mechanism now, right? Whenever there is a news item, and the price moves significantly, exchanges ask companies for a clarification, and then the companies respond. Sandeep. So this is over and above that?
Yeah, this is over and above that. So this is, let's say it says that a listed company A is seeking to acquire company B. It will create some of the issues which Hetal mentioned, which is very important because, when it's at a negotiation stage, if you disclose it, what will happen is, the target company B, the price is going to move up by, let's say, 20%. And then it may make the entire transaction unviable because the company can say, it can say either no comments, which I don't know if Sebi is okay with that. But if it affirms it, then the price goes up and the transaction fails. And they can't deny because ultimately that would be lying, and that's not allowed under law. So I mean, it will create a lot of tricky situations. But it's certainly above and beyond what is required under currently, and it's above and beyond what is required globally. I don't think any other jurisdiction that I know of actually does something like that.
Okay, this is the most hotly debated item, but as you said, Sandeep, it was a long board meet. Lots of things happened in the press conference. I mean, the chairperson answered questions patiently and over a period of time on so many issues. And we want to discuss 2 or 3 more things. Sandeep, on the issue of ASBA-like model for secondary markets, right? So basically money moves, money from your bank account moves directly once the trade is completed. It doesn't lie with the broker. I just want your thoughts on that. What will this do to the business models of, large brokers? A lot of them depend on the float, really, to make their money. Because the brokerage is, of course, next to nothing. I'm talking about companies like Zerodha, etc. Go on. Your thoughts?
Yeah. No, so I think it will certainly impact many of the large brokers. It may not impact somebody like Zerodha too much, but it will impact the companies which are kind of a lot more dependent on the float. And they'll have to just relook at the business model because this is what has come in. And, where this is coming from is quite different. It's not so much to do with saving, 2 days interest cost of investors. It's really coming from all the, scams, including Carvey. And, the law has been clear since 1993 that you can't commingle one client assets with another. You can't commingle your own funds and securities with another. So, they just, I think they've really not been able to, we've had so many incidents despite that. And therefore, I think this is kind of, they thought this is the only way to really prevent mischief and fraud.
Okay. There's another issue, right? On the mutual fund total expense ratio, there were certain announcements that came through where they said that brokerages paid by the mutual funds to be kept outside the total expense ratio. They do not appreciate double charging of unit holders. Hetal, I wanted your thoughts on this. How strong does SEBI's intent look? And does this eventually mean that the total expense ratio is going to be brought down further?
I think, look, unfortunately, this is not within my remit to answer, so I'll pass this to Sandeep.
Okay, Sandeep, you want to take that?
So I think the way things have moved over the past 2 years, there has always been a pressure in terms of a downward pressure, regulatory downward pressure on total expense ratios. In what forms and which how it comes, it's been coming from multiple areas. It started with around 2 years back. They said that competitive markets are not kind of working out well because despite kind of the kind of the competition that you have in, let's say, large cap schemes, the kind of fees that are being charged are not kind of going down. So they looked at the data and they said, look, we're going to reduce the cap. Then they looked at caps in terms of the tier 2 cities. Then they looked at multiple. So I think this will continuously keep progressing. And I broadly, I don't think it's a big issue for the simple reason, we've gone like almost 6x in terms of the fund size for mutual funds over the past 15 years. So whatever they've kind of lost in terms of the expense percentage, they've more than made up in terms of, being well regulated, being kind of, all the benefits that we've seen from mutual fund. And of course, there will be challenges, not just with TR, as you mentioned, but also the tax challenges in the debt fund. So all these things are a given, but I'm still kind of reasonably optimistic about this industry.
Hetal, very briefly, your thoughts on the measure to put an end to permanent board memberships. That is right in your coverage area or subjects that you look at very closely. What universe of companies will this impact and in what way? briefly.
So look, we wrote a paper about this in August 2022, and even when we looked at modifying our corporate governance score assessments, we had essentially said that this is something that we don't like. It actually impacts, in most instances, it impacts promoter-controlled companies, which is essentially 2/3 of listed India. Permanency of both these typically happens in two ways. One is where the promoter essentially embeds himself or herself in the articles of association. So a classic example is Dr. Vijay Mallya in USL, right, where despite Diageo having majority equity, he was embedded in the AOA to say he will remain chairperson given a certain very low shareholding threshold. As a result of which, he refused to exit and he had a legal right to stay on the board. This is something we see periodically. There are several more examples where in the AOA, the promoters have actually embedded themselves. The other way is to say that I'm going to get appointed, but I won't be liable to retire by rotation. So essentially, that means if I'm in a non-executive capacity, once I get appointed on the board, I just cannot be removed because I won't come to shareholders for another and that gives you another board structure. And the third is where you see in the newer startups that you're seeing, right, where founders not classified as promoters and some private equity, pre-IPO private equity investors have embedded themselves into the AOA with extremely low shareholding thresholds, or to say that if they remain in executive capacity, they will always be on the board. So therefore, it's essentially resulting in entrenchment. Now, you would argue that it cuts both ways. Investors like the fact that promoters have skin in the game. They're going to be there for a longer period of time. They will see the company through. But what happens is really when the performance starts deteriorating, there are financial leakages, there are concerns over governance, it becomes far more difficult for the stakeholders to therefore be able to effect change if the board is also going to be hand in glove with the entire process. And therefore, to say that, so therefore SEBI has done two things, right? One is to say that board permanency is no longer going to be allowed and all directors have to come up for approval every periodically. And the other is to say that special rights will also be sort of come back to shareholders. So this essentially, one, allows shareholders to vote on the board permanency or vote on shareholders periodically. And second is it also essentially allows promoters to be in the driving seat as long as they have shareholders.
Got it. Hetal and both of you, Sandeep, Hetal, this is a great conversation, and unfortunately we've run out of time, but we will definitely take it up later through the course of the week as well. Thanks a lot for joining in. Let's slip into a quick break.